Hello all, this is Rohit and today we are going to talk about IRR, which is internal rate of return. So what IRR exactly is used for, we'll talk in a very layman term so that it can be easily understood by the people, by everyone. And basically talk about this with an example. So the most common examples in our day-to-day life, IRR is used for calculating the return on investments which we are making. So may be it be the mutual fund investments or any insurance plan someone takes or any type of fixed deposits, to how much the cash outflows are and how much over a period of time we are getting returns on our investments. So we'll talk about this. So we won't go into the theory of IRR, the mathematical formulas type of things, but we'll use MS Excel formula so that we can easily and accurately calculate the IRR, internal rate of return. There are many calculators available online, so you can just go on Google or App Store or whatever to take out the calculations. But I would recommend that you use some MS Excel thing so that the accuracy is not an issue. Also, we'll take as an example, we'll consider two investment plans over a period of 16 years. So in market, there are two different theories of calculating IRR in the insurance or investment segment. So we'll try to cover that also in our today's video. So I'll just share my screen. So I hope the screen is visible. So in this table one, I have taken two uh, kind of examples in which there is an investment plan which is of total tenure 16 years. So the total plan is going to be working for 16 years, in which the investments is to be made for the initial 8 years. So the net cash outflow will be of minus, will be denoted by minus because it's going out, hence it will be in a minus sign. Then there is a waiting period of 7 years, and then at the start or at the end of eighth year, we are going to get the return on our investment. So for that, we'll be calculating the IRR. So if we can see that in for example one, if we can just see this column B. So column B, the date it starts from 1st of Jan 2020. So it is a very basic thing that whenever we buy an insurance plan, the very first premium which is due is on the very first D day. So if we see that the first premium is deposited on 1st of Jan 2020, and the next premium is due on 1st of Jan 2021. So over a span of 366 days, it is clearly seen that over a period of 366 days or 1 year, total two premiums are being paid. So in this example, I have taken 1 lakh rupees per year premium to be paid for 8 years, and at the end or at the start of the 16th year we are going to get the return. So according to the plan, we'll be calculating the IRR, because in both the things the IRR will come different. So I've calculated both and I will discuss both the things. So the 2020, it is termed as year zero. You can see in column C. So from year zero till year seven, total we are making 8 payments, which is of minus 1 lakh rupees each year because it's an outflow, hence it is denoted as minus. So minus 8 lakh rupees. And then for the next, at 8 years, we are not getting any payment. So from 8, 9, 10, 11, 12, 13, 14, these seven things I have put in zero because there is no cash outflow as well as there is no cash inflow. But if we can see that if we are getting the return on investment on 1st of January 2035, then it is exactly 8 years. So and I have taken a random value of 17 lakh rupees ki, we have invested 8 lakh rupees and in the return we are getting 17 lakh rupees. Okay, so it's almost double, more than double the amount which we have invested. But the main point of consideration is that are we getting this amount on the same date on which we are investing our money? So if that is the case, then we'll calculate it as mine. Then it is 17 lakh rupees on 1st of Jan 2035. So for this, if we'll calculate the IRR, so IRR is coming as 6.67. Okay. So now how I have calculated this? So it's a very simple formula. Just we have to write equals to IRR. Then we'll press tab. We'll select the entire range. Now if we see that the range is selected, now there is one more parameter, which is estimate. Estimate is nothing but we just estimates a value from our mindset, that we just suppose that how much the IRR can be. So it can be 10, it can be 11, it can be 2, it can be 3, anything which we can estimate. It's not a necessary value to be entered. But for example, we'll just enter, suppose we enter 9. I don't know the exact IRR as of now, so I'm just estimating it can be a 9% IRR. Then we'll press enter, but it's coming to 6.67, which is the exact. So our MS Excel will calculate the exact amount, but it also gives us the option to estimate the amount. Now suppose the same thing I go without this estimate function. So again, we'll just calculate, we'll just select the entire range, we'll leave this estimate nothing, and we'll just press the enter. Again the value is 6.67, so it's not a mandatory field to be filled, but it's totally our choice. So the, if suppose this return of investment we are getting on 1st of Jan 2035, then the IRR comes out to be 6.6727 to be precise. Now suppose we are getting this amount at the end of 2035. So technically, end of 2035 is equivalent to 1st of Jan 2036. There is a only 1 day difference. But if we see the overall structure, there is, the plan says it is going to work for 16 years, but technically it is working for total 17 years, from year 0 till the year 16, means 1st of Jan 2036. You can refer column E, row 19. So it is 1st of Jan 2036. Now according to the plan, we are getting the returns on 31st 12 2035. So it's almost again 366 days we have to wait for our return. So in this case the IRR will be less. So again equals to IRR, we'll select the entire range. Just a second. E- Equals to IRR, selecting the entire range and pressing enter. It's coming out 6.1367. Initially it was 6.6727. So the basic thing which IRR is used for is, it's most commonly used for calculating the return of our investments. Mainly it is used in our day-to-day life. It is used for any insurance plan, any mutual fund scheme, anything which we are investing, and we have to calculate that how much return we are going to earn on this investment. So this is the formula of using IRR. It's a very simple thing. It's a very simple formula and easy to use. The main thing is that we have to use our common sense. We have to go through our insurance, investment plans, or everything properly. That on what date we are giving the premiums, on what day we are investing our money, and on what day we are getting the money back. Means we are getting the return of investment. Accordingly, the IRR will vary. So you can post your questions in the comment box, and hope you like this video. Thank you so much.